All right. Well, thank you everyone for joining us today on a special webinar for health savings accounts and how they work and how you can self-direct them. This is going to be a topic which will probably be getting a lot more traction in the coming months with possible legislative changes. So it's good to start getting your notes out here and start getting educated quickly, as you may be able to use more of these accounts. And if you do currently use these accounts, please use this as a resource for you to be able to get some more information and possibly some more options for you as well. A little bit about myself before we get started. My name is Alex Perney. I'll be your presenter today. I've worked for Advanta since 2012. I've also held my designation as a certified IRA services professional with the American Banking Association since 2014. This accreditation does cover health savings accounts in any deemed qualified plans. So I can also speak very knowledgeably to education savings accounts, 401ks, IRAs, employer plans, and the like. So if you have specific questions about HSAs, or if you need some additional insight as to your options with 401ks or IRAs, or any sort of qualified retirement plan or anything that falls under the purview of the umbrella of the ones I just mentioned, please feel free to ask me those questions. I am certainly able to and willing to answer those questions for you. The required disclaimer before we do get started, Advanta and our employees, we do not provide any investment advice, nor do we endorse any investment products. All of the information here today is presented for educational purposes only, and any person that is taking this presentation today is encouraged to get professional financial advice, especially when it comes to health savings accounts, as they are very specific types of qualifications that you have to have before you can utilize one, and as to any type of investment that you want to do to make sure that it is a appropriate investment for you to be entering into at that time. A little bit about us as a company. We have been operating for several years now, previously as a company named Entrust, but we've been here since 2004. We offer a dedicated and local feel, and we have a much more flexible fee schedule than most other custodians, and our only business that we focus on is self-direction of qualified plans. That includes HSAs and 401ks and IRAs and the like. So any type of plan that you would like to utilize, you can also use as a self-directed type plan, and specifically going to be focusing today on the health savings account. So without really getting too far off track with regards to our other services, what is an HSA? An HSA is a tax-advantaged account for individuals to get a deduction for adding money into and then getting tax-free distributions for qualifying medical expenses. But the big qualifying event for this is that you have to have a high-deductible healthcare plan. Now, we're going to be referring to someone's asking me if I can adjust it up. I'm not sure if I can adjust the volume up if anyone's having trouble hearing me, but I'll try to see what I can do. But please, if you are on the other end, try turning your mics up. It might help as well. We will be referring to high deductible healthcare plans as HDHPs. So just if you are a little bit unfamiliar with the acronym of HDHP, it is high deductible healthcare plan. So a little bit of the history about this. Although health insurance and saving for everything has been around just as long as people have been saving money for medical expenses, the ability for individuals to save money on a deductible basis and get tax advantages for doing so is a relatively new concept in the liken of how you are able to do this with regards to your taxable situation. In 1984, the National Center for Policy Analysis published the first kind of direction on the issue that people really do need to have some sort of ability to save and get a tax deduction in order to pay for the rising cost of medical expenses. We start having bills come in the mid to late 90s that start covering different abilities and different types of structures to utilize for this. The first being in 1996, we have the Archer Medical Savings Account is introduced that is allowing people to have deductible contributions, but it is going to be tied directly to income and payroll that the individual is getting from an employer. So with that said, your health savings account is always going to be tied to your employer that you have. Now, this is great because you do get the added advantage of having two portions of contributions into it, so the individual is not having to make it all out of their pocket. But the downside is that the Archer MSA is inherently always going to be tied to the employer. So with that said, they are highly importable from one employer to another. So if you change or leave a job, you don't really have the ability to take that money with you. The contributions that are going to be made into a Archer MSA are going to be inherently very restricted in that regard. So although we were able to start getting the groundwork laid towards the late 90s and early 2000s for what is going to become the HSA, it certainly was not a perfect system. Coming into 2002, we have health reimbursement accounts. Now, these are nice because they can be rolled over from year to year, but again, they're still going to be tied to the employer. So you have the ability to, instead of just having the contribution be made in two separate portions, you can also utilize it to reimburse yourself for the medical expense that you're incurring. Now, this is kind of the biggest precursor that you're going to see to the HSA, because it most similarly resembles the ability of the HSA to pay back and reimburse for qualifying medical expenses after the expenses recurred, or to pay for them directly. But the big limiting factor, again, with the health reimbursement account is that it is tied directly to an employer. I myself just experienced this. My wife changed jobs. We had a health reimbursement account, and we lost the $1,200 balance that was vested in that for us. It was kind of unfortunate, but again, that is the nature of those types of plans. Then in 2003, we have health savings accounts. Now, the great thing about this is that they are portable from job to job. You can roll them over into several different accounts if you'd like to, and you can also use the money in them for non-health related reasons as well. There might be some inherent penalties or some additional tax you have to pay, but the HSA offers a far greater degree of flexibility for the individual that has it in order to be able to use the funds as they see fit. You're not just going to be restricted as to only qualifying medical expenses. However, if you do want to get the great tax advantage of deductible contributions with tax-free distributions, it does have to be for a qualifying medical expense. So here's a little bit of enumeration on what we just covered. The Archer MSA, named for the representative that brought it into existence. The contributions are made by employer or employee, but not both, limited to self-employed and small businesses, and the contributions are based on a percentage of annual deductibility. The flex spending account covers expenses not paid by insurance, including deductibles, copays, and co-insurance. And under the ACA, you can carry over $500 from year to year. Now, the maximum contribution into that type of plan being $2,600 a year, and again, non-portable from job to job. Now, the great thing about the health savings account is that the government, in everyone's different opinion, is actually encouraging people to save for their medical expenses. They're giving them a great tax incentive as getting a deduction dollar for dollar on their income taxes, and they're also getting tax-free distributions for the actual qualifying medical expense. The impetus for doing this is that people will be more aware of how they spend their own money instead of just supplying many different types of claims to insurance. If they're using their own money, people under this system of assumption are going to be a little bit more cognizant of how exactly they are spending the money and on what they are spending it for, and ultimately will lower healthcare costs in theory, because people are being much more selective and much more informed about the decisions that they are making with regards to their healthcare. It is also supplemental to healthcare coverage. So you have healthcare coverage with an HSA. You don't have to have zero insurance in order just to be able to get this great tax deduction. You're still an insured individual, but you have a great deductibility tax plan, and you're also getting tax-free distributions of money. So if you're growing that money, the growth on that money can inherently, if you're doing your investments that are paying out in a commensurate amount with how much you are needing to spend, the earnings on your investments can simply pay for all of your medical expenses that you have under this type of plan if you are seeing enough growth to do so. But the potential there is quite interesting. So you have the tax-free growth, just like an IRA, tax-free distributions for the qualifying medical expenses, and the HSA supplements a high-deductible healthcare plan allows payment of non-covered healthcare expenses with tax-deductible money. So let's kind of break that down a little bit. You can contribute $3,400 a year and get a tax deduction. At a 20% tax bracket, that's $680 in savings and taxes on your 1040. Now you have $3,400 of expenses and pull money out without tax rather than paying the expenses of after-tax savings. So to have $3,400 in after-tax savings, you would need $4,250 in earnings. So the ability to have tax-free distributions without having to have inherent growth as you would have outside of a health savings account in order to pay for those is really kind of illustrated in this instance, because essentially you're getting an additional 20% of your spending power on that money instead of having to pay income tax on it. You're creating a deduction and also being able to pay for that qualifying medical expense. Now, there are two types of HSAs. You have an individual HSA and a family HSA. They're fairly intuitive as to what they cover, but just to break it down for people, we have this illustrative slide, is that an individual HSA covers only one individual with a solo healthcare plan, so an individual with a high deductible healthcare plan, and a family HSA covers all members of a family that are in that unit. Now, think of it like this, is that your family in the most traditional sense would be your spouse and children. However, these plans can cover anyone that you claim as a dependent. So if you are an individual that has maybe a family member who you claim one of their children as a dependent, or you have taken legal guardianship of another individual that is claimed as a dependent, or if you have an elderly parent or someone that you are needing to claim as a dependent on your taxes, these people can be covered with the tax-free distributions from a family HSA, so long as you are still covered under a high deductible healthcare plan. So it's important to remember that a family HSA is what's going to be utilized when looking at qualifying medical expenses from spouses and anyone you claim as a dependent. So we're kind of looking at this a little bit through rose-colored glasses. Now, unfortunately, we do kind of have to get to the eligibility for being able to have one of these great types of plans and a few of the restrictions that are offered out there. So for those of you that are trying to take notes, again, this will be uploaded to our YouTube channel. So if this is a little bit of information that's going a little bit quickly, this is being recorded and it will be put up on our YouTube channel. So if you want to grab it later, feel free. Don't take a rush stance and try to get as much notes taken as possible. You have to have a high deductible healthcare plan to cover to qualify. Now, many people, when they're looking at the Affordable Care Act marketplace websites, might be saying, well, the deductibles are certainly very high, and indeed they are, and the out-of-pocket expenses may be very high as well. However, one of the big qualifying factors for the high deductible healthcare plan is that you cannot have a copay for office visits or prescriptions. So if Benny, yes, you can certainly get a copy of the slides. If you can just do me a favor, all my contact information will be at the end of it. Just shoot me an email, and I will reply back to it with a PDF of the slides. And that goes for anyone as well. Please do that. So that is one of the big limiting factors, and the reason that a lot of people think that, hey, my deductibles are very high, and they may very well meet the deductible limitations and qualifications for an HSA, but when you look on the Affordable Care Act's marketplace website, you're going to see that it is non-HSA qualified because it has a copay for prescriptions or other preventative care. So the types of things that can be included, you certainly are going to have inclusive of preventative care, annual physicals, prenatal, child wellness, immunizations, and certain screenings. For 2017, the self-coverage deductible must be at least $1,300. And for 2017, the family deductible for the high deductible healthcare plan has to be at least $2,600. So a lot of those do certainly fall within that range. It's just a matter of the fact that a lot of these plans out there right now do have some sort of copay, so therefore they are going to disqualify themselves from being HSA qualified. Now, your out-of-pocket maximums are for a self-covered individual are $6,550 and family coverage of $13,100. So that would be the maximum that you're paying out of your pocket a year. And remember, the deductible limit is going to be $1,300 individual, $2,600 for the family. Now, the continuation of this, it does kind of look strange, I know, but the first slide was all point one of high deductible healthcare plan and the limitations. Here are the other three portions of the four requirements. You cannot have other healthcare coverage, so you can't have multiple types of health plans. However, that does not include certain types of supplementary coverage. You can have dental, long-term disability, or workers' compensation. So something in any state that you are covered by a workers' comp plan that doesn't disqualify you, having things like AFLAC and the like for lost wage coverage is not going to disqualify you. And with certain medical expenses, if it is dental or vision, you can still include those types of expenses and qualifying medical expenses, but you can also have coverage for them as well. You cannot be enrolled in Medicare, so if you are on government-assisted healthcare, that is going to preclude you from being able to have an HSA, and if you are being claimed as a dependent, you cannot have an HSA. So if someone is utilizing you for the purposes of covering under a high deductible healthcare plan, HSA family plan, you cannot have an HSA if you are considered the dependent in that scenario. So you have to be the income earner that is claiming the dependence. You cannot be a dependent of the income earner and still have a health savings account. Okay, we have a question. Let's see. My husband and I have individual healthcare plan, but I saved some health savings accounts money. Can my HSA savings pay for my husband now and in the future, or is my HSA money can only pay for myself now and in the future? That is a great question. You really do kind of need to field that question more to a tax preparer because, one moment. With regards to when you qualified for that HSA, you have to have the medical expense has to fall within the time that you qualified for the HSA. And if you both had individual accounts that were established at different times, without really knowing the timing and everything else, it's really hard to say whether or not the HSA money that was put away could be qualified to use and pay for the qualifying medical expense. Even if it is qualifying, it has to fall within the date range that is applicable for that. So getting with a CPA and getting your medical records for that is going to be a better determination made outside of Advanta as to being able to pay for that. All right, Elliot asks, if my spouse doesn't have a high deductible healthcare plan, but I do have a high deductible healthcare plan, can I use an HSA to cover her expense, or only my own? We do not have a family plan. We each have our own individual plans. In that instance, it would lead me down the path of you not being able to necessarily cover her because you are the one with the high deductible healthcare plan maintaining separate coverage, and if you have an individual HSA, it would probably, at least with the way that it is structured, that probably would not be something that you could cover for her expense. However, the ultimate determination on that kind of fine detail of covering her on that would really need to be made by a CPA. But just with the fact that you are the only one with the high deductible healthcare plan and she maintains separate insurance, if she is covered by a plan that is non-high deductible or non-HSA qualifying, it wouldn't seem that that expense would be in a qualification of coverage. But again, that real determination needs to be made by a tax professional. But definitely a good route to look down. Thanks. Okay. Again, great. Thanks for the questions. Keep them coming. And moving on. So Elliot's question was really good because it kind of brought us in, and the previous one was good because it brings us in to how do you qualify. So let's say you're covered by a non-HSA qualifying plan for quite some time. Excuse me. And then you change healthcare coverage, change jobs. Some circumstance happens where now you do have a high deductible healthcare plan. Well, there's some considerations that have to be given as to when you can establish that plan, when you can contribute, when you can distribute from that plan, and what happens if you do not qualify during what's deemed to call the testing period. So I don't always like to read stuff off, but let me just enumerate what's written down here for you. For the purpose of making a full year contribution to an HSA account, you are treated as having a health savings account for a calendar year so long as the HDHP plan is in place by December 1 of that year. So that means that if you have other health insurance so the entire year and then mid-November you change insurance to a high deductible healthcare plan, so long as that it's done and enacted before December 1, so on 12 o'clock midnight of December 1, you have a high deductible healthcare plan, you can have deemed to have opened that you can have an HSA for that year. Now, your contributions are going to be affected by that, but that is what's going to qualify you for being able to establish a HSA within any sort of given year. Okay, thank you for your questions. Let me just get through a couple of these. Benny and Michael, I do see your questions. Let me just get through this slide and we will address those. So as an example, Ben enrolls in an HDHP plan November 30th, 2016. He can then contribute the full $3,350 to the HSA account for 2016 and take the deduction on his tax return. If Ben loses the high deductible healthcare plan coverage prior to November 30th, 2017, he must take a pro rata distribution from the HSA account. The pro rata distribution is the amount of the distribution divided by the number of months, and then the subsequent number of months that you lose coverage is going to be the pro rata that you have to pay the 10% tax penalty on. I do realize that's a lot of information. That is a really good question to get with your tax preparer on if you do lose high deductible healthcare coverage and then you are changing coverage and you have an HSA and have made contributions in that given taxable year. For the purposes of this presentation, taxable year is January 1 to December 31, so just keep that in mind. Okay, I'm going to leave this slide up and we'll address a few of the questions. Must contributions to an HSA come from earned income? Yes. You have to have earned income that's commensurate with the contribution that you are making. You can certainly make that contribution out of a savings account, but you do have to have earned income that is at least on the level that you are contributing into the plan on a given year. Okay, do HSAs provided by employers have the same high deductible limit? So unfortunately, there is a little bit of ambiguity, if you will, Michael, on that point, is that when you do have an account that some people call a health savings account provided by an employer, it's not really an HSA. It's going to be a flex spending account where they're contributing into it on behalf of you, and your part of it is being contributed in by you on that. That's actually a flex spending account or an MRA, a medical reimbursement account. They are non-portable, and they don't necessarily have to have the same high deductible requirement. They typically will be a more high deductible plan, as they are slightly cheaper for an employee to provide to their employer to provide to their employees, but they don't necessarily fall into the same purview as an HSA. Now, those types of plans aren't necessarily going to be qualifying for an HSA, because almost all of those types of plans will have some sort of copay. Now, that copay can certainly be covered with that flex spending or that medical savings account dollars, but again, they are fall under the same umbrella, but they are definitely not the same as an HSA under the context of this presentation. Okay. Benny asked, must it be the same high deductible healthcare plan, or could it switch from one to another? So long as you have a qualifying high deductible healthcare plan, it does not matter necessarily so much that it is the Blue Cross HDHP and then you go to a Humana HDHP. It can be different ones. So long as that you are still covered under a qualifying high deductible healthcare plan, that's what the IRS uses as a basis for making sure that the qualification and the contributions are being made accordingly. So you can change providers just so long as that you are maintaining the qualified type of plan is what they're really looking at. Okay, Mike asked, if you Do you lose it if you don't use it? The answer is no. The great thing about an HSA is that it rolls over from year to year. You can have this thing until the date of your death, and then your spouse can take it as their own. It is a really great plan because unlike the flex spending accounts and medical reimbursement accounts, the MRAs and the FSAs, this is your account. This is an individual deductible plan that you get tax-free deductions out of that stays with you for life, no matter where you work, if you become unemployed, if you are self-employed or anything else, you do get to keep this plan. So that's a really great thing. It's not a use it or lose it type of plan. It's a continual growth vessel. Okay. My husband has an HDHP plan during 2016. Can he contribute HSA for 2016 before the tax filing deadline? Yes, you can make previous year HSA contributions. The reason they say that is that because most people, you have to know when you have made enough money, so you can certainly do that up until your tax filing deadline, and that is timely tax filing deadline. There is not extensions included. The only small extension you might get is that if the 15th falls on a Sunday or federal holiday, you have until whatever the deadline for that happens to be. So the 15th, the 18th, something like that is when you're going to be limited to making a previous year contribution to that. So great questions. The contribution limits have not changed a whole lot. They have changed for self-covered HDHPs. A humongous $50 has changed from year to year. So 2016 limits were $3,350, and the family plan is still $6,750. Catch-up contributions in the amount of $1,000 if you are over the age of 55. Contributions must be made in cash. You cannot contribute property, stock, or any other type of tangible asset as an in-kind contribution into an HSA. You can only do it as a cash contribution. Now, some people may or may not be aware of, but you can do a one-time funding rollover from a traditional or Roth IRA to an HSA to fund the account. However, this is not kind of like an unlimited amount of money you can just roll directly into it. It is limited to either the self-plan or the family plan coverage limits of $3,400 to $6,750 on an annualized basis. So whereas it is great that you are being able to do that, the actual impetus for being able to essentially overfund it, it really isn't there. So depending on your strategy, take it for what it is. It may or may not make most sense to you, especially if you have a Roth IRA. Since your Roth IRA contributions are always 100% basis to you individually, what that means is that if I contribute $5,000 into my Roth, I get no tax deduction for it. All of the earnings are growing completely tax-free, but I can always pull that $5,000 out tax and penalty-free. So if I have a Roth IRA, there really isn't much of a need for me to do a conversion or a rollover of those funds to an HSA, because if I have a medical expense, I can take that money out and use it. Now, I'm not going to get any penalty and pay any taxes on it, just like I wouldn't in an HSA. So rollovers from the traditional typically are the way they go. You can do it from a Roth, but remember, since you are 100% based in your contributions to a Roth IRA, it may not always make sense as to why not just use the contributions in there and still get the tax-free distribution. And one thing you cannot do is you cannot use a SEP or a simple IRA to do the funding rollover. However, if your simple has been open for 2 years, you can transfer the funds to a traditional IRA and then just do the rollover from there. Conversely, with a SEP, you can transfer out money to a traditional IRA and then do the funding rollover to the HSA. So just because you can't do it directly out of a SEP or a simple doesn't mean you can't do it. You just need to be a little bit creative and think through the proper channels of how to make sure the funds are coming from the actual right type of account at the time of the rollover. Okay. Contributions can be made by employee or employer or on behalf of an employee. Now, previously, just to make sure there's no confusion, if an employer is making a contribution to an HSA, that certainly is allowable. But just because an employer is making a contribution on behalf of an employee to a type of spending account does not mean it's an HSA. So you do need to check with your employer to make sure that if you are getting a contribution into some type of account that is not just a payment of your premium, but is some type of spending account, make sure you know what type of account that is, because that is going to directly affect the portability and the ability of you to control that account when you leave that employer. Because remember, MSAs and flex spending accounts are non-portable between jobs. So if you leave that job that they were contributing into, you do lose it. However, if an employer is contributing into the plan on behalf of the employee to a specific health savings account, that is directly portable. You own that 100%, and you can take that with you when you leave your job, not a problem. So just make sure you understand exactly what type of coverage, what type of contributions, and what type of account that they are providing to you, and it'll make sure that you're making the correct decisions and know exactly what you have. Contributions are tax deductible if made by the employee. So I make a contribution in there, I get a direct line item deduction on my 1040 that adjusts my modified adjusted gross income down, commensurate with how much money I added in on that annual basis. And remember, deductions can be taken even if you don't itemize your 1040. So even if you're still just doing a standard deduction, you can still get the deduction for adding into an HSA even if you're not itemizing that deduction. Okay, so here's the cool part about HSAs, is getting money out of them. So a distribution, as we've kind of touched on briefly, is the money that you're going to be taking out for a qualified medical expense. Now, that qualified medical expense is going to be a tax-free distribution so long as that a few items are met. It has to be qualified. Now, if you are looking to get a comprehensive list of what is a qualified medical expense, refer to IRS publication 502. They have a huge enumerated list of all of the different types of what they deem qualified medical expense that you can take a tax-free distribution for. The list is like 7 pages long, so we don't include it on this just because it is very comprehensive. So just refer again to that IRC 502 for a complete list of medical expenses that do qualify. And the expense has to occur after you have established the HSA. So if I had broken my leg last year and I don't have a high deductible healthcare plan until this year, my plan started as of January 1 of this year, I can't pay for any out-of-pocket medical expenses from that broken bone in the previous year. Now, let's say I wreck my bicycle tomorrow and I have an HSA, I can certainly use that money to pay for a qualifying medical expense, related to that injury. So keep in mind that even if you do have very comprehensive records of previous qualifying medical expenses, it has to have occurred after the date that you established the health savings account. And here's just a few of the types of qualifying medical expenses that you can utilize these plans for. Your deductibles. So remember, because you're not having any sort of copays, you can use this for a deductible from your healthcare provider. The cost of the doctor's visits, dental care, so all the things that go along with that, vision, medications. Now, most medications people think of as prescriptions. Think of it like this, is that if you have a prescription for something, it can be covered. Now, some people get prescriptions for things that are over-the-counter. Those over-the-counter medications, if you do have a prescription for them, can be covered by a health savings account. So a lot of people get prescriptions for ibuprofen, prescription strength ibuprofen, things like Claritin or allergy medication. If your doctor, or heartburn is another good one, if your doctor is writing a prescription for that and you have a prescription to back up the expense for the OTC medication, you can use that as a qualifying medical expense. However, if you do not have a corresponding prescription for that, so if you go to Walgreens or CVS or Rite Aid and buy aspirin and use your HSA to buy it, but your doctor has not prescribed you an aspirin regimen, that is not a qualifying medical expense to use for that. The only thing that is completely exempt from that is that if you do have a need for insulin, most people, obviously will have a prescription for that. But if you do have an underlying case where you do not have a written prescription for insulin, insulin is always available to be utilized for a health savings account qualified distribution. Chiropractors, bandages, and other first aid kits, disabled dependent care. One really interesting carve-out to this is that if you use the cash for an improvement to a home for the main purpose of medical care, so something like installing wheelchair ramps or lower countertops for wheelchair access, different types of things that can be determined to be qualifying just for a medical necessity, you can utilize that for home improvements. Long-term care and lodging and expenses for medical reasons, if you had to take a trip to a specific specialist to get a certain type of treatment that was deemed medically necessary, you can use it for the actual expense and lodging that is associated with that trip. So now some excuse me, non-qualified medical expenses, because again, just because it is a medical expense or something related to your actual health care does not mean that it is deemed to be qualified under Section 502 according to the IRS. So healthcare plan premiums cannot be paid except for COBRA benefits, non-prescription drugs. So any non-prescription drug that does not have a prescription basis, so things like aspirin and ibuprofen, allergy medications, heartburns, things like that. If you don't have a prescription for it, you cannot buy the non-prescription medication with the HSA. Cosmetic surgery, things like teeth whitening, nutrition supplements, cosmetics and hygiene products, health club dues, or payment for future medical expenses. Now, I kind of want to bring people down to the very bottom of that, payment for future medical expenses, because there is the ability to pay for past medical expenses so long as that they incurred after the actual plan was, or the HSA plan was established. Now, this brings us to our next point, is that the IRS expects you to keep records of what you're paying for with the health savings account. This is a very end-user-based record-keeping type plan, in that you are expected to keep receipts of everything that commensurate with how long you're expected to keep your tax reporting. Keep in mind that if you are going to be utilizing this for any type of past medical expense, that they will expect you to show adequate records showing that it was occurred after the plan was established and that it is qualifying. And the medical expense has also not been taken as an itemized deduction in any year. So although you are able to deduct any sort of contributions made to an HSA, even if you do not itemize, if you are itemizing and taking a deduction for a qualifying healthcare expense per IRS guidelines, you cannot then in turn also take a distribution from your health savings account in order to pay for that expense as well. Benny asks, can you keep a soft copy of the receipt, e.g. a scan of the receipt as a PDF, or must you keep the physical receipt? In all honesty, I don't know the actual, hard definitive answer for that. I would say that so long as you are keeping a good copy of it, not just a handwritten ledger, if you have scanned it and everything, I would like to think that, people are relatively reasonable and that the heat transfer paper doesn't always hold up for very long. So long as you have a good copy of it and you are maintaining good records with best faith, that should be fine. But ultimately, that's going to come down to the IRS. But they just state in Publication 969 is that you have to have backup and supporting documentation as to the qualifying medical expense. Unfortunately, they don't enumerate like they do for the types of medical expenses as to what is appropriate backup, but that is what they do indicate per their publication. Okay. So when and how to make distributions from an HSA. As I said, you don't necessarily have to do it at the exact time that you incurred the medical expense. So if I go to my doctor and they need to do something, whatever it is, it's qualified. I don't have to pay them directly out of the HSA at the time that the service was rendered. I can keep that receipt, pay it out of pocket, and so long as it's not itemizing my deduction and claiming that as a deduction on an itemized 1040, I can pay that at any time in the future that I want. So here we go. Our friend Joe opens up a self-only HSA and makes a $3,400 deductible contribution. Joe has $1,000 of medical expenses from May through December of 2017. And at the end of the year, he takes a $1,000 distribution from the HSA tax-free. The remaining $2,400 plus any earnings are made into the HSA for future expenses. So this is an example of the same year. He makes the contribution, has a qualifying expense, pays it out, no taxes are paid, and he gets a deduction. 2018, Joe makes another $3,400 deductible contribution to an HSA. In March of 18, Joe has surgery costing him $3,000 out of pocket. He takes an immediate distribution in March to pay expenses, leaving $2,800 in the HSA and accumulates Joe leaves $2,800 in there and then accumulates $500 more expenses in 2018. Now, at this point, he didn't wait till the end of the year to take the distribution. He paid it directly at that time. For whatever reason, he just wanted to take the money out, didn't want to float the bill for that. That's perfectly fine. Just make sure you're keeping records of all those expenses. So coming into 2019, Joe has $2,800 plus the earnings from the past 2 years in his health savings account. He had $500 of qualifying medical expenses, but does not take a reimbursement. In January, he makes a $3,400 deductible contribution to an HSA. During the year of 2019, he accumulates another $1,000 of qualifying expenses, but takes no distributions. So, excuse me, he has accumulated right here $1,500 of qualifying medical expenses, but hasn't taken any deductions. He didn't take it on his 1040 and didn't take any distributions either. So he just paid for it and is just holding on to his receipts for future reimbursements from that. Now, in 2020, Joe has $6,200 plus the earnings from the past 4 years in the HSA and $1,500 of medical expenses. Joe again makes his annual contribution and accumulates $1,000 or roughly thereof of expenses, but takes no distributions from the HSA. So now he has $2,500 of qualifying medical expenses. So skip forward 10 years, 2030 rolls around. At the beginning of the year, Joe has $60,000 in his HSA, so mixture of contributions and earnings. In the last 12 years, he has had $20,000 of qualified expenses, but took no distributions. So from the time that he stopped taking distributions to then, $20,000 of qualifying medical expenses. Joe takes a $20,000 tax-free distribution from the HSA. Now, remember, he had the qualifying high-deductible healthcare plan starting in 2016, established his HSA, made contributions, made earnings, and then roughly 14 years later, he takes a distribution for everything he has not already taken a distribution for or a deduction for as a qualified tax-free distribution from the HSA. All right. Excuse me. So we have some good questions. Let me just take a sip of water. Okay, Benny asked a great question that we're actually going to get into it here in a minute, but it is, can you have a self-directed HSA? And the answer is absolutely. We administer HSAs. We don't do nearly as many of them as we do IRAs and other types of accounts, but it is certainly something that investors that want to get way more diversity and want to get tighter control of their investments underneath of the plan can do. So you can certainly self-direct it, we can handle it, and we can kind of walk you through what it takes and what you need to look at with regards to doing qualified investments under an HSA. And the types of investments that you can do in an HSA are exactly the same as what you can do in an IRA or a 401k and a SEP IRA or a simple. There are no restrictions past what the IRS already puts on to as to whom you can invest with and not being able to invest in collectibles or life insurance are the only two things that are non-qualified plan investments, so that also applies to HSAs, but there aren't any sort of additional considerations to give for investments that cannot be done specifically by an HSA. So great question, Benny, and we will be getting into a little bit more of that here in a moment. Okay, I saved some medical expenditure receipts, which I paid by after-tax money, and this medical cost happened during the time I had the high-deductible healthcare plan. Can I get the tax back for my pre-tax money? I honestly do not know the question to that. That would be a much better question fielded over to a CPA. With regards to getting pre-tax money back late, it's just really not something that we get asked or have much expertise in, since that is a personally taxable matter. All right, Michael asks, if you have money in an HSA, can you choose to itemize 1 year and make no contribution that year and pick back up contributing the next year? I don't see any inherent issue with that. I mean, that is a personal taxable situation. You can still maintain the HSA, and it's not going to disqualify you from having the benefits of holding that plan. Now, do keep in mind that what you're going to be limited on is that if you are taking distributions for the qualifying medical expense, if you are itemizing your deduction, you cannot have taken an itemized deduction for the qualifying medical expense. So if you itemize your deduction, but you're itemizing your 1040, but you're not taking an itemized deduction for the qualifying medical expense, you could still use potentially the HSA in that instance. The big determining factor is that you're not, essentially double dipping and getting a deduction and a tax-free distribution and also a deduction for the qualifying medical expense as an itemized 1040. So just keep that in mind. It just depends on how you're actually filing as to what's going to make the most sense and what's going to qualify that. So just get with your CPA and they'll be able to kind of guide you through if you need to itemize 1 year and you can take a standard deduction the next year, as to making sure that if you are utilizing a high deductible healthcare plan with an HSA, that you're not, double dipping it and taking 2 deductions and getting tax-free distributions. So good questions. Good questions. Okay, and then to finish up the example with Joe, he decides he wants to remove some of the funds from his HSA, but has no more qualified expenses, so what are his options? Well, unlike with the IRAs where you have the age of 59 and a half where you can start taking qualified distributions without penalties, the HSA is specific to the age of 65. If you are of the age of 65, you can take distribution from the HSA without the 20% early withdrawal penalty, but you have to include it in your ordinary income tax. So at the age of 65, you can kind of treat it as a traditional IRA, and that the distributions are only taxable at ordinary income and you don't have any penalty, but you do have to wait a few extra years for that. Now, with an HSA, the great thing about this, as opposed to the flex spending accounts and the medical savings accounts, is that they are directly portable for wherever you go, and you can name beneficiaries of the HSA. So if you name a spouse as the beneficiary of the HSA, they have more options than anyone else does. And just like with an IRA, they can treat the HSA as their own and continue the HSA plan qualifications to pay for qualifying medical expenses of themselves or other dependents that they claim. And it doesn't necessarily, get rid of the HSA as a whole. For a non-spouse beneficiary, the HSA ceases to be qualified, and the value of the HSA is taxable to your beneficiary in the year you die. So if you leave it to someone that is not your spouse, when you pass away, they get a tax bill for the value of the HSA. Now, if you name your estate as a beneficiary, the value of the HSA is included in your final tax return. So it is treated mostly just like personal cash if you are not naming your spouse as the beneficiary of the plan. Excuse me. So now we're getting into, what can you do with this? There is so many different ways to invest HSA funds that we could spend a whole another hour on doing that, but we're not going to. We're going to kind of briefly go through some of this, as we are kind of coming up on an hour, and I do want to respect your time. So if you do have any questions, feel free to start getting them in there. We're going to be covering the remainder of this presentation on some options that you have for investing the money, and not so much more on the actual regulations and rules for qualifying, contributing, and distributing from these types of accounts. So you can invest in any number of things. It doesn't just have to be what your current provider gives you, such as stocks, bonds, and mutual funds. You can do things like real estate in any form. You can do raw land, commercial joint ventures, residential condos, duplexes. You can also get involved in the paper side of investing. So you could lend someone a mortgage loan. You can invest in tax liens, unsecured notes, all sorts of really cool things where you're actually lending money out and not holding maybe the real estate directly in title of the HSA as well. Now, this isn't just limited to mortgages and things directly tied to real estate. You can also be involved in things like limited liability companies, do equipment leasing, commodities, certain types of precious metals are also allowable for HSAs, just like they are IRAs, to be invested with. Now, the good question that we had is that, are there any type of restrictions as to what an HSA can invest in? The answer is really no, nothing past what 401ks, IRAs, SEP IRAs, and simple IRAs can do. So it is covered under the exact same purview of those types of regulations. Constance asked, what are Forex accounts? On the previous slide, Forex accounts are accounts that you establish and trade foreign currency. So if you open an account with US dollars, you would purchase various pools and different amounts of different currencies with the expectation that the exchange rate of them is going up or down pursuant to your basis of what type of currency that you are looking to take out of it. So it's just betting on the rise and fall of different currencies. Benny asked, can you show the real estate slide again? Sure. And again, if you are missing anything, or if you think I'm going a little bit quick through this, if you do want the slides, I can email you a PDF copy of them after I get done with this. You'll have my email up at the very end, and we'll also be putting up the slides to our YouTube channel tomorrow, along with the recording. So if you are missing a few things, feel free to just shoot me an email or just check our YouTube channel tomorrow, and they will be up there. So the restrictions to HSA investments are going to be life insurance. Your HSA cannot hold a life insurance policy as an investment. So even though that, and it's not considered a qualifying medical expense either. So as an HSA is not a living, breathing entity, it cannot be the beneficial holder of a life insurance policy, as life insurance policies are already typically paid out tax exempt anyway. And then it can't hold anything that is a collectible. So anything that derives its value from inherent subjectivity. So antiques, alcohol, artwork, rare stamps, rare coins. Some coins are allowed. So if you are doing a precious metal investment, certain types of coins are allowed if that is something that you'd be interested in investing in. But these are the only things that are inherently off the table for your HSA to invest in. And then there are certain people that you are unable to invest with, meaning that you cannot directly purchase something from one of these people. However, you can partner potentially with these people. And we're going to do a closing segment on how to partner, because inherently most people are going to think, well, this is all wonderful and great, but my HSA just doesn't have nearly as much money as my IRA. Well, there are ways to help bring your HSA to the table in bigger deals by utilizing partnerships. And keep in mind, just because you can't buy something from one of these people doesn't mean you can't partner with them. So take everything I'm saying with a little bit of an asterisk, in that, you can't buy from these people, but you can partner. So I cannot buy something from my spouse. So I can't go to my partner and say, hey, I want to buy the house that you owned before we were married, or that you bought in your name directly. You can't be on the other side of the closing table from them. And this goes with any of these people. However, you could potentially come together with that individual and make a new investment happen by bringing the funds together as a tenant in common. Lineal descendants or ascendants of the HSA owner, so that is your grandfather, grandmother, or son or daughter. So anyone directly up and down from you in your family tree is disqualified from you dealing directly with in that regard, just as your spouse would be as well. And also a business entity owned or controlled by one of the above. So if someone owns or controls one of these, that's either your spouse, your mother or father, or your son or daughter, that would also disqualify you from utilizing your HSA to purchase something directly from them. So Heather wants to buy real estate with others who fix and flip property. She has $20,000 in an HSA currently that's just invested in something like mutual funds or stocks at her current administrator. So the impetus here is that she really does think she's going to be getting better gains by lending money out on an equity participation note. For those of you who don't know, an equity participation note is structured in that instead of getting a fixed rate of return, say at 8% monthly on the outstanding principal, what you say is that instead of getting monthly payments of principal and interest, that when the property that underlies the note sells, you will receive your principal back plus a certain percentage of the profits that are made from the sale of the property. So that is what she's doing here, is getting into an equity participation deal with her HSA. Now, in this instance, by utilizing partnerships is one way that we can bring up the capital amount of the HSA to a level commensurate with something being a little bit more directly involved with real estate. So Steve's acquired property for rehab, but needs $20,000 for the cost to then sell. So then Laura offers Steve the $20K from her HSA to split the property under the equity participation note. Now let's take a look at a few of the terms of this loan. So she has $20,000 to lend out from the HSA. Equity participation means that she's going to get 25% excuse me, of the profits when the property sells, and it's secured by a first mortgage on the property. The payoff is the total profits on this. The payoff in this instance is that there's $30K in profits of the sale. The tax-free income back to her HSA is $7,500 plus the $20,000 that she invested on the basis of principal in that loan. So now she has $27,500 in her HSA that can be used to pay for any qualified medical expense incurred since she started the HSA, or she can continue to grow the HSA through additional investments and then take distributions down the road that are tax-free for qualified medical expenses, or if she reaches the age of 65, are just going to be taxed at ordinary income without a 20% penalty distribution. Now, that does bring us right up to 1 o'clock, and I pretty much hit the nail on the head with getting you right there for an hour of your time. Thank you very much for taking your time today to be with us for a health savings account presentation. It was my pleasure to present the information to you. I encourage you to take down my information, and if you have any questions, email or call me directly. I don't put my cell phone up there, but if you do have anything that you need to reach me for directly, as I am in and out a lot, it's 850-524-2880. So feel free to reach out to me directly. I want to be a resource for you with regards to these, and if you have any questions, I'll stay on for a few more minutes and you can get those typed into the chat box. With regards to Benny, does Advanta have a list of investors that we could use for self-directed HSAs? Although we can't necessarily put you in touch with someone that you could invest your money with, what we do like to do is provide good networking events and different things for you to participate in, so that way you can kind of make the deal happen organically. We have our Brewing Success in Florida, which is where we hold a guest speaker and investor networking at a local brewery. We also do one in our Atlanta area as well. That's coming up at the end of February. But we're getting more details on the February one for Florida out. But we essentially like to have the right people in the right place at the right time to make deals happen. But unfortunately, in our role as a self-directed IRA administrator, we can't directly provide you with the person providing the investment. But we can certainly try to make sure you're in the right place to network and make that deal happen. All right. Are these real estate gains, like participating loans and flipping profits, subject to UBIT or like other self-directed IRAs? Just like with any type of qualified plan, depending on what you're doing, you might subject yourself to UBIT. Chris, yes, you can certainly, if you just please email me, I can send you a PDF copy, but the slides will be on YouTube tomorrow. But back to the UBIT question, it all depends on what you're doing with it. So if you're doing a flip, but you're not doing enough to deem being qualified for UBIT, so you do 1 or 2 a year, or potentially more, depending on what the qualification for your specific instance is for UBIT, it certainly would not apply. But if you are deemed to have a UBIT liability, the HSA would also be liable for that. You're very welcome.